Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Good evening to all the people who've joined into this webcast this evening. My guest this week is Mr. Nimesh Chandan. He's the head of equity investments at Canara Robeco Asset Management Company. Nimesh has had a very distinguished career in the capital markets dating back to over 2 decades. Over the last decade and a half, he's worked at various fund houses, Birla Mutual Fund, SBI Mutual Fund, ICICI Prudential Mutual Fund, and then was initially the head of the offshore division at Canara Robeco and now is in charge of the entire equity investments over there. He's had many distinguished achievements to his name. During his time at ICICI Prudential, he was voted as one of the best technology and pharma analysts in the country for 2 consecutive years in the top 20. He was also awarded by ICRA for being one of the best sectoral fund managers in over a 1 year period. So it's a pleasure to have you on, Nimesh. Good to be speaking with you. A lot of memories must have come back as I gave that intro, I'm sure. But awesome. So I want to just start off by asking you and hoping that all is well and safe in office, family, friends, everything, and that you're keeping good.
Yes, thank you, Rahul. Also, thank you for inviting me for this webinar, this platform. Yes, everybody is fine, thankfully, around me. And I hope that all the participants who have joined today, they are healthy and their loved ones are safe. And good evening to everybody.
Excellent. Thanks for those wishes, Nimesh. So let's get started about, the entire journey, so to speak. And I want to specifically start with your tenure at ICICI Prudential. And you had, I think, or was it when you had just joined Canara Robeco, where you had actually sent out an email to your team saying, I love the bad times? Talk to us a little bit about that email and what were the learnings around that. And as an investor, was it, once, or I wouldn't say once in a lifetime, but one of those very few moments that you get to pick up stocks at such value?
Yeah, I'm actually pleasantly surprised, Rahul. You picked that up. Yeah, so, and in a life of an investor, you actually learn once you go through the whole bull bear cycle. And it's only in the second cycle that you come out to be more saner and more intelligent and smarter, I guess. So this email I had written to colleagues in 2008 in the midst of the financial crisis, and when it was all doom and gloom. I had written it in November of 2008 when market had corrected. Sensex, I think, it corrected from 21,000 to 8,800 or so. Mm-hmm. The market still remained down for, I think, 3-4 months, even post that. But the experience I was citing was of 2003. When in my previous cycle of a down cycle, when I had seen after the Twin Towers issue and so on, I had met with a friend's uncle at his place, and this guy was selling insurance policies. And he told me that, why don't you pick up some insurance policies yourself? Well, I said, well, fine. What do you have to offer, or what are the options? And he told me about ULIP plans, and he said, okay, invest with, it's better to take endowment policy rather than a ULIP plan because markets, are very bad these days and so on. And I said, don't you think it is better to invest now in the markets rather than later? When it is at a high. And he gave me a half-an-hour lecture how he had invested in 1992 in certain funds, and then he had not made any money. And in 2003, again, he was in the red. So, and the guy had a lot of experience, so I lost the argument at that time. In 2006, I met with the guy again. And by that time, he had turned into a day trader. So he was talking all kinds of scripts. He was doing FNO. And he was very proud that he didn't carry the position the next day. He squared it off at a profit the same day. Mm-hmm. So this actually instigated, but in 2008, that story came to my mind, and I wrote to people that I love the bad times because in bad times, I lose arguments, but I make money. So that was the genesis of why I enjoy being in the bad times. I entered the year in the market in the year 2000. So I have been a contrarian since then because I have seen markets collapse to crazy levels in valuations. And those have been the best buying opportunities. And fortunately for good investors, it has come every few years in the Indian market.
So it's interesting you mentioned the word contrarian, Nimesh, because my guest last week was probably an old colleague or a friend of yours, Mrinal Singh from ICICI Prudential. And, he's extensively about being a contrarian investor. How does one become a contrarian investor? And how do you identify themes and how do you have the courage of conviction to continue to be one?
So contrarian at heart means you are generally looking to see where the crowd is going wrong. So you are trying to take advantage of crowd's overreaction or underreaction to any phenomena. Suppose they have gone into euphoria, you start looking at things which can make you worried about the market. When they are going into depression, you start seeing if there are any green shoots in the market, and then position your. Yeah, not many people also focus on underreaction. Many a times after a series of say disappointment, if a company starts delivering good results, there is also an underreaction by the crowd. People don't really accept that this company has started doing well or the cycle has turned. Analysts retain their sell ratings. Though they may upgrade their earnings estimate, they retain their sell ratings on that company. So underreaction is also an opportunity for a contrarian. But what I realized over time is contrarian, just the word that you have to go against the crowd doesn't mean that the crowd is wrong all the time. It has a lot to do with the timing. And you have to endure a lot of pain because facing the whole crowd against you it takes a lot of emotional strength. I was told that neuroscientists have found out that the part of the brain that gets affected by going against the crowd is the same part of the brain that starts feeling the pain if you have any physical pain. So going against the crowd is as painful as breaking an arm or a leg. And it takes a lot of emotional strength to get through that. And timing becomes very important here. You have to get a good idea that this is the time in both fundamental and psychological terms, that this is the right time to go against because the crowd has extended a rally or depression too much.
So I'm going to dive a little deeper into this right away, Nimesh, but at the risk of, sort of drawing the ire of my pharma analyst, since you said you upgrade the earnings and still keep your sell, we spent a lot of time on our internal pharma groups debating Biocon. And I've always, so I hope my pharma analyst doesn't throw something at me for having brought this up. Since he's a terrific guy, but since you mentioned it, I thought I'd just bring it up. So, as a policy, I don't discuss stocks or markets on this show, and I haven't done it for the last 3 months. But I just want to take this point a little forward about being a contrarian and ask you to just put a practical example to it in your past experience. When was the one time you took a contrarian stock call or a sector call? How did you arrive at it, and how did it work out for you?
There have been many because I institutionalized this contrarian thinking in a certain manner. In the early 2000s, I came across a study done by Richard Thaler and DeBont, and they had studied the US market and the performance of stocks. What they found out was if you make two portfolios, one is a winner portfolio of stocks that have done extremely well for the past 5 years, and then another loser portfolio of companies that have done extremely bad in the last 5 years. In the subsequent 5 years, most of the time the loser portfolio outperforms the winner portfolio in the next 5 years. So that shows that people actually overreact to a certain extent, that glamour stocks become extremely expensive and vulnerable to negative news, and the underperformers become extremely vulnerable to positive news that can come. And many a times people read the cycle wrong, and that also adds to it. So based on this model, Richard Thaler actually started an asset management company, and then he later sold it to JP Morgan. We did a study of the same phenomena in the Indian markets. And now it is part of our investment process to look at companies that have underperformed for a period of time. This has helped us catch, say in 2000, in the near term, I can say in 2018, by say the March to June quarter, we were able to look at corporate private banks, say like the Axis, the ICICI and so on, where the NPA cycle had peaked and we were looking at significant recovery in earnings and in ROEs. So that has helped us very well. Last year, pharma companies were at that stage where people were very bearish about them, and typically you would find that international generic companies like Sun Pharma or Dr. Reddy's, even Divi's was actually coming in these screeners where market was not expecting much from them. People had overreacted to the downside and they were underperforming significantly. So we took into account those. We looked closely at that sector because it's a little different from banking. In pharma, you can have, and I can support your analysis that it's a very difficult sector. I've been tracking it for 20 years. I've not become a doctor, but I've become patient. And for 20 years, I've seen that there are very brief periods when the whole sector moves together. Otherwise, you will find that there are certain large cap companies at 52-week highs and certain at 52-week lows. So it's very difficult to really take a top-down call. But on a bottom-up basis, you can find a lot of companies where people have turned extremely bearish. And the more complicated the sector, the bigger the chance that the crowd has got it wrong. Because people really don't dwell down into numbers so much. Even if you see accounting practices, there may be, if you do forensic of a lot of companies, you will find that stocks which are the market darlings of a certain period of time have shown markers of issues in their cash flows, but people don't closely look at these analysis and then they can go wrong. So those are opportunities. Personally, I have been more tuned to looking at things like, like a bat on a, to look at everything on the opposite side. I think Charlie Munger also says that always invert and see whether the assumptions that the market is making, the expectations that they're making are right or wrong. And to some extent, I have also learned a little bit on this from George Soros. One of the first books I picked up in finance was Alchemy of Finance by George Soros. And where he actually explains that when you see a bubble forming, first participate in it. Then when the expectations get very extreme, then you reverse it. It's very easy to say, it's very difficult to do it, but something that can act as a framework for a contrarian, that this is how you actually participate.
Since you mentioned Munger and Soros, I'll come to Ben Graham in just a bit, because I know you've read him too. But this one issue you mentioned about the losers doing better over a period of time, anecdotally they say if a newcomer wins a Filmfare Award for their best debut, they probably don't succeed much after that in the film industry. So I want to draw that analogy. You spoke about cash flows. How difficult is it as a fund manager when you look at, say, leverage companies in infrastructure or metals? And we've seen this in 2008, where these stocks double, triple, or even go up 4x in a matter of a year. And you have to resist the temptation not to touch them, risk underperformance, and hope that the growth at the reasonable price phenomena that you stuck to sort of pays out. I ask you this in the context, and feel free to give a slightly longish answer on this. I ask you this in the context of the fact that you are, working with probably the second oldest mutual fund in the country. Your performance has been exemplary for the fund over the last 10 years. In fact, you've probably been one of the top quartile fund managers. But your equity AUM has only grown from 4,000 to 18,000, and I haven't seen too many NFOs come through. For the kind, while reading the research, I would have thought that the size of your equity AUM should have been many-fold than just where it is. So, I hope you get what I'm trying to say. And if you can just detail for the benefit of our viewers, how is it that you've gone about doing this?
Okay, so let me start from the very beginning. At Canara Robeco, we have always chosen to be in certain spaces and focus on certain spaces. we have decided not to be in certain areas. So strategy actually demands that not only you decide what you want to achieve or what you want to focus on, you also have to take a stand on what you don't want to participate in. And which is why I think the total AUM, that when you compare to other uh, asset managers who have come during that time, would be different. But to tell you the genesis, in 2008, when I joined this company, the joint venture was just formed, and the organization had gone through a lot of changes on people, on the management side. And I was actually part of the new team to join and set up investment philosophy, investment processes for the company. We did not have any offshore advisory business also at that time. So that I set up in 2010 onwards, and we've had a huge amount, tremendous amount of faith from our investors. So in the first couple of years of setting up an offshore advisory business, we were able to attract investors like the large pension funds in Europe, sovereign wealth funds. So we've enjoyed a good clientele, and a lot of these clientele still stick on with us. We have not tried to just raise money through launching multiple NFOs. There have been certain spaces, even in the fixed income side, we have stayed away from because it didn't make sense to us. In the equity side also, we have launched NFOs, which at a point of time when we thought it made sense for investors to look at it. For example, in 2009, we launched a consumer trends fund. While right now, almost everybody for the past few years is talking about consumption growth in the country, during that time, you could find actually a Hindustan Unilever or so at like 15 to 20p. Right now, people would love to buy it at 50p to 2 years forward or so. So I'm just saying, as an example, there were a lot of companies in the consumer area which people are not looking at. People still had the overhang of the infra boom that had happened in the past 4-5 years during that time. So we launched the Consumer Trends Fund to tell people there's an investment opportunity here. In 2011, there was a very tough year for Indian market overall, especially financials. We were seeing higher inflation, currency was under pressure. There were news about the euro credit crisis and so on. So we launched a large cap fund at that time, that this is an opportunity where even the large companies can become multi-baggers for investors. So we launched a large cap fund at that time. And just about 2 years back, we launched a small cap fund. Because small caps had the worst underperformance to large caps. As a category, it's a tough category to track, but there were beautiful gems within that. Leaders in their sectors, leaders in an emerging industry. We found leaders who were niche players who had fantastic cash flows. So we thought this is a good opportune time to launch a small cap fund. So we've been very choosy about the segments, the markets we want to be playing in. We want to launch product that really makes sense to the investors at that time, not just to add one to our basket. And actually, we are very happy to see that in the returns, we are among the top mutual funds, even if in AUM, we are not hungrily running towards a certain set of larger AUM. I think happy clients will get you that anyway.
So how do you resist the temptation? That was part of my previous question of, when you see these so-called not so quality stocks doing well, and how hard is it not to chase them and stick with quality even though you may be underperforming in the medium term, short to medium term?
Yes, so I think it takes a lot of, as I said, to go against the market and not participate in something which you don't believe in. It takes a lot of strength. Most of the people give into temptation because mainly of stress or pressure that they go through, that I need to perform this month or need to perform in this quarter or so. I would say from our within our company, we have the right ecosystem and within the team also. So if you take within the company, our shareholders, our management are very supportive of our investment philosophy and process. And they actually like that we are sticking to a certain quality of companies when we are selecting them. As a team also, we've put a culture of quality in the team. Here, it's not that we are against leveraged companies, but we are against companies where people are buying these leveraged companies on hopes of a turnaround. If we see a company having a good business, say ROEs can go up to say 25 or 30 or so, but it's just going through a down cycle. We're not averse to that. Those companies may have debt on their balance sheet, but during an up cycle, they perform. So it's not that we are against certain companies, but we want to choose within them. And historically, the experiences, if you see in the last 10 years especially, have reconfirmed these beliefs. So there would be a short burst of performance within, I would say, companies which have substandard asset quality or substandard quality of fundamentals. But that is always short-lived. And you will see in the following year, again, what investors make in those companies, they lose out again in the following year. I'm not saying that there would be bad companies within that, but I have learned that if a business is not able to generate good cash flow or good return on capital that they invest in, it's very difficult to bet that that company will continue to grow and be able to create shareholder value. If there's a change in business, we look at it, review the companies very well. As I said, we have a screener that forces us to look at underperformance to see what can go wrong. But within those 30, 40 underperformers, we are able to find out companies which can do better. So like you said in the awards function, like, the newcomer, the person who gets the fresh face award or the best debut award doesn't do well. Thankfully, this market doesn't give such award to one person, gives an award to such 50 people. Okay, we have to choose the ones which actually can sustain their performance and maybe get Ranveer Singh within those fresh faces that have come.
No, that's well put, Nimesh, because I remember in the year 2007-8, there was a frenzy of real estate IPOs that had come through. I mean, I remember at least a dozen of them. And the largest listing of the time, I remember it had listed in 2007, which was a financial year 0708. And the kind of projections that people had for its profits 3 years out. Incidentally, that company has never done that top line in a single year. Forget the profits. So I understand what you say when you talk about bunching up companies in such a way. I want to go back to some of the thought leaders that you mentioned, and Ben Graham talks about temperament over knowledge. How applicable is that to investing in the Indian stock market? In many ways, it's still a very nascent place to be, in terms of penetration and the number of people actually interested and invested in the stock market. Where do you stand on temperament versus knowledge? Because today knowledge is of various kinds. There is digital media, there is television, there is the world of WhatsApp, which is probably the most knowledgeable person in the market today. So when you weigh these two, is it more temperament? Is it more knowledge?
So I'll split this answer into two parts. One, talking about what Ben Graham has been saying. Actually, if you go through the book Intelligent Investor, and if you search for the formula to calculate intrinsic value of a company, you won't find any. In fact, even in his other book with David Dodd, Security Analysis, you won't find a formula for intrinsic investing. And Ben Graham actually tells you that you should only know which side the intrinsic value lies, and you should buy it with a margin of safety, just because you can go wrong in those projections. So the whole book, actually, Intelligent Investor, is more about thinking about investments rather than doing investments. It gives you an approach that this kind of investment philosophy or process will help you make better returns in the market. So I take it more as a psychology book rather than an investment book. So that's one part, and I'm fully on board with that temperament makes a big difference. And the second part, I'll tell you why it is becoming more important now. In the year 2000, I think Russell Fuller wrote an interesting paper about what is the source of alpha for fund managers and for investors. And he said it is about having better expectations. Means you should be having better expectations than the crowd, which is how you will be ahead of the crowd. So you will be able to, better expectation not mean you're bullish, but better expectations about getting that story right. And he said there are three edges that you can have to generate alpha. So you can have three sources. One is the information edge, the other is the analytical edge, and the third is the behavioral edge. Now, the information edge is about getting a good understanding of the business, projecting the numbers right, trying to meet with the management, trying to listen on the conference calls, and gather more and more data, more and more information. Now, if you want to be ahead of the crowd with the kind of information uh, blast that we have these days, and you mentioned WhatsApp correctly, it is very difficult to think that you will have information about a business earlier than the others and better than the others to act on it and make more alpha than the others. It's very difficult. Two, I think it's becoming more expensive also. I hear about certain hedge funds in US actually sending drone cameras to the parking lots in malls to check out, like, whether consumers are coming to the shop or no. I think this was something that they're taken from McDonald's, how they used to monitor whether the shop is doing well or not, depending on the cars that are there. So information edge is actually diminishing, and it's very difficult to have, and it's becoming more costlier. The second is the analytical edge, where you process information better. Though everybody has information, you process it better. That's your analytical edge. You have a two-factor model or a three-factor model of projections. But let's put it this way, that once it is copied by many, again, it stops working in your favor. The third is more profound and more longer-term edge that you can have is the behavioral edge. And because human beings don't change, so we are the same, and it may take probably a century for us to change our behavior. Fear of loss, fear of missing out, greed, hope, loss aversion, all these biases that we have will stay with us for longer. This is where behavioral edge takes advantage of it. It can be combined with information and analytical edge, but behavioral edge is important because you will be able to find out where the crowd has overreacted or underreacted. Second, it is for your own self to improve your decision making. If you understand where people can make mistakes and where you can make mistakes, you can identify those biases and de-bias or re-bias yourself. That's, I think, the most important edge that one has over a longer term. And I'm a big believer in the behavioral finance side. So even in our investment processes, we have put tools and ideas from behavioral finance to improve our decision making.
I'm going to ask you to elaborate on that, but just before that, since you mentioned this example of drones and McDonald's, it takes me back to a period in time when Indigo had just listed, and we were actually on a flight to Delhi with some fund managers and some people from the buy side to a series of meetings there. And we were actually, if I'm not mistaken, we were probably on the 4th or 5th row. And the fund manager actually, once the flight was in the air, got up, walked the aisle of the flight to try and get a sense of who were business travelers, who were pleasure travelers, actually had a word with one of the air hostesses to understand the F&B, and was probably one of the last people to exit the flight because he wanted to walk off with the captain of the flight to understand the mechanics in greater detail. So I've seen ground research happen at various levels. So since you mentioned that, that's actually one of the memories that came back to mind. And I remember for that full day in Delhi, I kept pulling his leg about him doing that and extrapolating what happens on one Indigo flight to all of these others. But can you expand a little bit on behavioral finance? You've written a lot about it. You use it a lot. We have almost 300 people on this broadcast as we speak. Can you just elaborate a little bit about why it is so important and what goes into the makings? How is behavioral finance to be easily made applicable or practically implementable in your day-to-day investing?
So let me first give you share an idea on the survey that your friend did, the fund manager did on the Indigo aircraft. Most of the time, and this is also a bias that generally human beings have, when we incorporate new information into our decision making, we generally give a lot of value to the strength of the signal rather than the weight of the signal. I'll give you an example. Suppose you're testing a coin, whether it is biased towards heads. You're just trying to flip the coin and see whether it is head biased. It has more heads coming. If you do 3 of these coin tosses, 2 of them come heads. Now, that means 66% of the time, the coin gives heads, which is a very good signal in terms of its strength, that yeah, the number of times is higher. But the weight of that information is weak because you've done only 3 trials. It's a very small sample. If you do the same trial over say 100 times, and then within that, if you find that 55 times it's heads and 45 times it's tails, now the strength is very weak of the signal, but it still has some credibility because the weight of the information is better. So when we are looking at surveys, a lot of people do these dealer surveys and consumer surveys and so on. But one should be very conscious about whether the weight and the strength of the signal both are that good to incorporate into decision making. The other thing is people are always biased towards information they get personally, whether versus they get from a secondary source. So if you're buying a car and you hear about people, a consumer survey report saying that brand A is better than brand B, and then you go to a party where your brother-in-law tells you, oh, this is, don't go for brand A, it's horrible. Like, I had a horrible experience, one of my friends has it, and so on. So rather than us taking it as one input into the number of customers that have bought brand A, we generally go with that this is our personal experience, so it definitely matters more than the consumer report. So I think those are biases we need to take care of. Why should somebody look at behavioral finance? And a lot of investors feel, why should I waste time there? I'm working well on just doing fundamental analysis. Fundamental analysis will give you the price, intrinsic value of the stock, and a vague idea about that. What you also need to see what the market has already incorporated. Just because you're looking at a stock once, it doesn't mean it was discovered that day. And the stock doesn't remember that you bought it at that price and doesn't try to hover around that price or go higher from there. So it is important what the market is also incorporating. In one of the newsletters, I had written a story about Julian Robertson, one of the brilliant fund managers who was running a hedge fund called Tiger Management. It was one of the first hedge funds in the world, and started in 1980. By 1997 or so, they had $25 billion under assets in management, and which was, I think, the biggest hedge fund also at that time. And Julian Robertson was the wizard of the Wall Street, as he was called. In 99, he bet against the internet stocks, the .coms. He said, this is crazy. Like, people are paying for clicks rather than cash flows. And first he disinvested from them, then he shorted them. By September, he started seeing pressure on his performance. Money was going out. And between September 99 and March 2000, the stocks doubled again. So he actually shut down the fund in the year 2000. In March 2000, he shut down the fund. And within 1 month, all the crash and the panic he had predicted actually happened. So those .com became the 90s club, stocks that have lost 90% of the value. So this shows that while, the crowd, you can take advantage of it when it is going wrong. But the crowd going wrong can also be a detriment to you. So as people, the old adage goes that markets can be irrational longer than you can remain solvent. So it is important to understand behavior of the crowd, important to understand your own behavior. Now for us at Canara Robeco, among the processes that we have, one, I told you about behavioral screeners that we run to see where the crowd is. Internally, to identify our biases and then say correct them, we use several tools. So one of them is an investment checklist. So any new company that comes into our investment universe, we have a checklist of questions that the analyst has to answer before the company comes in. This is because we don't, in a rush to buy a company, we don't forget about the important steps in the analysis. And it also standardizes your analysis. The third most important part of checklist is it's a reservoir of all our previous mistakes. Now, to err is human, but to repeat it would be stupid. So it's better to keep those learnings from your mistakes into that checklist. A question should be, so suppose we lost money in a company because it had very high client concentration and that client went belly up and the company lost revenues and profits. Now that has to be incorporated in your checklist. The next time you are evaluating a company, is the company vulnerable to one client or a set of clients? So you learn and improve, reduce your errors there. Our analysts, they give 3 target prices instead of 1 target price. Most of the people think that intrinsic value is 1 target price. No great investor will tell you that intrinsic value is 1. It keeps changing. And analysts, because they work on these companies very closely for months together, they may actually develop certain biases towards those target prices, and they are not able to get an out from them. Keeping a bear case scenario, doing a pre-mortem and doing a bear case scenario and a bull case scenario gives you idea about what scenario can change and what you should do at that time. For fund managers, it gives a risk-reward ratio. For the analyst, so again in pharma, I will tell you an example. A company that we had in our portfolio had a warning letter from US FDA, and a 486 from US FDA. And when we went through that, we found out that there's a very good chance of a warning letter in this company. The stock was down 10% that day. In a bear case scenario, which started opening up with the warning letter, we could see 40% downside from there. And so even when it was 10% lower, we cut our positions. Now that experience is because you have done a scenario analysis. Otherwise, most of the time what happens is people get stuck to their calls and they rationalize it. This is called cognitive dissonance, that they will only accept things that confirm their calls and reject anything that goes against it. For fund managers, we have a certain process called a captain's log. This is from Star Trek, actually. If you remember, I'm pretty old, so I remember during Doordarshan times when Star Trek used to be on TV. Every episode, Captain Kirk would start his episode saying, "Star date so and so, we are going to this planet or this Klingon war." So recording of decisions becomes very important. If you record every investment, so fund managers here record every investment decision that they make, whatever buy or sell that they have, they write something about it. So when we are evaluating at the end of the year, we just don't look at numbers. So this worked well, this didn't work well. We also look at the reason why it worked well. If we have made a mistake, put it into your checklist. If it has worked well, can we incorporate it further into our decision making that such kind of companies do well or such kind of events help the company. It also shows the difference between luck and skill. Sometimes you bought a company, fundamentally it didn't do well, but the company got acquired by an MNC, you got an open offer, you make a big amount of money. So learning between luck and skill is also important. And then we look at making hypothetical portfolios on, there's a formula given by John Kelly, who was a gambler actually. He was trying what bet sizes to put in every gamble. We try to do it for stocks. So when we have bull bear case analysis and the probabilities around it, we try to create a hypothetical portfolio that with the best cases of high upside and low downside, which are the companies that fit in, and we create a hypothetical portfolio. Now, this is used to nudge analysts and fund managers about whether if they have a different set of portfolio based on their numbers, why is it? Is it because of a certain bias that they have, a certain fear that they have, a certain greed that they have? We are able to nudge ourselves into better decisions. And you need, I think, over a longer term, if you do 10 to 15% of better decisions, either by picking the right companies or by avoiding the 10-15% of pitfalls, overall you do extremely well in this business.
I'm extremely glad I asked you this question because you've given me so many ideas I can go back and implement in our own research team that I could probably discuss with my head of research.
My pleasure.
Thank you. Portfolio that you just mentioned. And I think the point you make about a bear case, bull case, and a base case is well taken. We've tried to do that, and one of the examples that comes to my mind, and I'll tell you why I raise this example, is actually IGL. And, when we initiated on IGL about 18 months back, we did a bear, bull, and a base case analysis. And I remember when I read it, I was actually quite happy. And I'll tell you why. If you remember at the early part of this decade, there was a day when IGL was actually down 60-70% one day.
Yeah, I remember.
And I don't get into the details of that. And I actually know somebody who used to hold 7-8% of IGL at that point, and very unfortunately, as well as I knew that fund manager, it unfortunately landed up costing him his job. So I take your point very well about having this, sort of characterization of having a bear case and a bull case and a base case. So it's probably something that I can take on with my head of research offline as well. But for the amount that you've read, Nimesh, and you've quoted so many, and in fact, the example that you gave of Wizards of Wall Street is one of the first books that I read in the US after my graduation. And the example that you gave is, I think he was one of the first three case studies in that book, if my mind serves me right. I mean, I don't get a lot of time to read off late, but I used to read a lot before just as I finished my graduation. But the Stoic Investor, which you started writing, and I follow that on LinkedIn, and I do tend to like your reports every now and then. A lot of it obviously is influenced by these people and your thought process. It comes out from when I'm hearing you. There is a clear reflection of what you're reading into what you're writing. Tell us a little bit about how liberating this process of writing is for you, how it helps crystallize your thoughts, and how does it make you a better investor? Because I know people on the sell side who probably write research reports for 10, 15, 20 years and then say, bhai, bas ho gaya, ab kuch aur karte hain. But you're still doing it after 20 years. So this process of writing, how important is it as an evolution of a person? And how does it help you in better investment decision making analysis?
So I've always believed that writing something down, and when you are actually distributing something that you have written, gives you two benefits. One, it helps you learn, because whatever you want to write, you want to have it thoroughly researched on it. And second, it makes you write only what you have, what you can justify or you can have good conviction in. While talking in a certain happy mood, you may make a forecast about a company for next 30 years, this is going to be a multi-bagger or so on. But when you're writing it down, it gives a little commitment, and you see to it that you do a lot of work. So every Stoic Investor that I'm now writing, in a week, I would be going through somewhere between 200 to 700 pages of articles or books or research papers on these. I want to be thorough about what I'm writing. So it's very liberating for me. It actually gives me a good idea about that whole subject that I'm writing. So though if I'm writing about, say, contrarian investing, I write 5 pages, but I go through about 500 pages to have that opinion and have those ideas. It's a tough job to write it on a weekly basis, but thankfully, because I have been early into reading a lot of these books and articles, what it takes me is to connect these from my previous experiences and what I hear from some of my very learned friends. I connect them and put them in there. How I got into behavioral finance is also about from a book or a magazine that I was reading. So in 2003, when I was an analyst, I was returning back on a Saturday afternoon in train, and I picked up the Bloomberg magazine. So those days we used to work on Saturdays, so it was half day generally. And on the way back in the train, I used to pick up something to read. And I picked up this Bloomberg magazine, and it had done a cover story on Daniel Kahneman, who had just won the Nobel Prize in the previous year. So he was the first psychologist to get a Nobel Prize in economics. And so I went through that, and I found out that there are a lot of companies working towards getting the behavioral edge. So I started working from, say, 2004 onwards to get this on these research papers and try to identify. And surprisingly, what happened was everything started getting connected around. So when Warren Buffett talks about be greedy when others are fearful and fearful when others are greedy, or what Nassim Taleb is talking about the black swan and how people react to it. In fact, Nassim Taleb writes about how after meeting Daniel Kahneman, his ideas got further strength and clarity. So when I looked at the best investors, I reread Alchemy of Finance, and it made better sense to me then. So this is one area that started connecting, and I thought that most of the successful investors in the world, I won't say all, but most of the successful investors, they are very strong in their emotional quotient, in their understanding of human behavior. Then they are stock pickers or market timers. And I thought that this is, because it is so important, I better write something about it, looking at different aspects about it, a lot of people don't read academic research because it becomes very complicated. It has a higher level of algebra, and the scientific language that they use is actually complicating. But I thought if there is a way where we can communicate to investors uh, about these ideas in a simplified manner. There is also a selfish motive into it. Um, I want my investors to have a good idea about how their fund house is thinking, how their fund management team is thinking, how their fund manager is thinking. And it is better to communicate to them that this is what we believe in, and hence be with us, rather than showing them a number that, we have done extremely well last month, so please invest with us. I think when people come to you, when they agree or they also believe in what you are believing in, I think that creates a very good long-term fruitful relationship for both. So that's the the perspective of writing these
Sure.
newsletters.
No, that's interesting to hear. Have you learned more from your mistakes or the mistakes of others?
Definitely my mistakes, and I think it is a different uh, experience altogether when you're just pointing out somebody's mistake. Again, I'll give you some anecdote on it, and which is one reason why I came to the buy side. I was a sell side analyst for 5 years, and I was doing pretty well there. So I was handling tech and pharma, which right now would be a crazy combination for any analyst to have. But I used to have that, and I was recognized in Asia Money for 2004 and 5 as one of the top analysts for that. So I was doing pretty well. But one evening, a company announced results and they announced a corporate action. I was very sure that stock will be down. So it was Friday evening. Stock, I expected Monday would open 40% down or 50% down. It was an FNO stock, so it had to go down. And I wrote my report with the price of Friday closing and saying, okay, I turn the company down from, or downgraded from buy to sell. And I sent it out. While going home in the evening, I thought that, what I have written is an absolutely useless piece of paper for the fund manager who's owning the stock. Okay, suppose the stock is 500 and it's going to open at 300. Okay, me downgrading the stock at 500 is absolutely crazy. I mean, he won't get that price. And there will be 50 other analysts who would have done the same. So what goes on through an investor's mind when he's actually going through that pain, rather than a third party observing from the ring side and saying, okay, buy, sell, oh, you should have done that. I think they call it Monday morning quarterbacking also, that you say, oh, Sachin should have played like this, or Virat should have played like this. What goes through your mind is very important, and a lot of things you learn when you're managing money. And actually, that's why I took a decision that I want to move from sell side to buy side and understand what goes through a person's mind when actually deploying money, and the adrenaline rush when you make money. So I think that's, so I have learned from these experiences. The reason I came to the buy side was that. And I think it's, as I said, over cycles, you actually mature. You look back and you actually think sometimes, like, how could I be so stupid? And when you are in that cold state, so there is a hot state and a cold state, where in cold state, you are absolutely rational, you plan big things. I won't have that cheesecake. I want to be on a diet. I want to be fit and so on. But when it is offered to you, you're in a hot state, you just eat it. So in a cold state, pre-commit yourself and put certain processes that stop you during your hot state. So I think that really helps in improving decisions. At least I have seen that pre-commitment helps learning from mistakes and implementing a process which stops you from committing those mistakes.
So I'm going to ask you a very selfish question, which I'll try to implement at my firm. As a fund manager, how do you view a change in recommendation? So if I had a buy on a stock today and I made it a sell, just let's take the same example that you had. And conversely, if I had a sell on the stock and I upgraded it to a buy, when you are reading such a report, what are the questions that are arising in your mind when, and questioning the change in rating? Since that's one of the reasons you made the switch from sell side to buy side, what goes into your mind when you read something, and when is it justified for an analyst to be making that switch, either which way, from a sell to a buy or a buy to a sell?
I'll give you an example of a analyst I used to follow. This guy was a tech analyst, and most of the time, his target prices were wrong. Most of the time, okay. He would be very bad at timing the buys and sells, or giving a certain higher target price or lower target price. But I always learned something about the industry, about the trends, from that, talking to that analyst or going through his reports, and that helped me make my decisions. Now, at that time, the buy sell recommendation or the target price did not matter at all. In fact, people who rely too much on the change in recommendations and target prices are actually using shortcuts. They don't want to take their own decision. They go with somebody else's decision based on that. So I believe that analysts or experts in the sector, okay, they know much more than probably I would know about a company. They have in-depth knowledge about it. I would like to benefit from their knowledge, their perspective, what industry trends they see, rather than be nitpicky about, okay, you told me a buy at this time or sell at that time. That's a fund manager's decision. Two, in sector analysts, I think there was this international study done by one of the large foreign firms where they took top recommendations from every analyst and made a portfolio out of it. And that portfolio underperformed the index. They did it the second year. Yeah, so they did it the second year. It again underperformed the index. The third year also it did the same. So they were wondering, what is it that analysts are giving their top recommendations, but the portfolio is underperforming? And they found out so many biases that even analysts go through. And they were extremely knowledgeable, experts in their field, probably rated very well across. I think that's more important. Take the knowledge and take your own decision. And when you take your own decision, you stand by it. Otherwise, you just want to pass the blame, or you don't have full conviction in those calls. And because the sector analyst looks at his sector or her sector, for fund manager, you need to also see whether, no matter how crazy the price is of this stock, it is still better than what he's seeing in the other segment. I think that's very important. So don't hassle about upgrades and downgrades at your company, but how the research that you provide behind a call on a company, I think that becomes more important.
I can't believe you brought up that thought process of going through that entire 11 or top recommendations of every analyst. We were just having this discussion with our friends the other day, if you could have a cricket team with 11 Ben Stokes in it, and how that would do if you have 1 to 11 of them with Benny Stokes, and how that would do. For someone who reads as much as you do, Nimesh, apart from the conventional stuff that we have discussed, securities analysis or intelligent investor, or, the ones that are written on Buffett, or even market wizards, anything that's interesting that you would suggest for the benefit of our participants who joined in today? That's a good read. A simple read, but a knowledgeable one, something that they'll walk away with.
So I recommend generally people having some idea about behavioral finance and psychology behind investing, because it's not in the textbooks today. So people who have gone through MBA courses or CFA courses or so, behavioral finance has now started coming at the back chapter. What you have learned in the previous 20 may not be always true. That way you get those end notes from the behavioral finance side. I think they should be at the front of the textbooks. So people who have gone through schooling or MBAs and all that have definitely missed that aspect of it, and that is more important in the market. So I think reading about behavioral finance is important. The other area that once I heard about, asked his friends, can you send me a recommendation of which book to read for learning investment? And the list, which is the best investment book that they read, and the email that he got from his friends, all the books were non-investment. So they were either about business or about psychology or about history or something. I think that is very important for an investor. It's not that you have to learn about concept of a price to earning, of a EV to EBITDA, or a DCF valuation. That's not the only thing to learn. Well, market concepts, valuation concepts are important, but learning about history, learning about businesses, learning about psychology, the consilience of these subjects. I think that will make you a perfect investor or a better investor or a stoic investor, as I would call it, than just reading one aspect of it. Within behavioral finance, I recommend generally books by Hersh Sheprin, Beyond Greed and Fear, Misbehaving by Richard Taylor. Nudge is a very beautiful book. It's something that you should take up. That is by Richard Taylor and Sunstein. And one of the books that I believe that you can implement in any function that you're doing is the Checklist Manifesto by Atul Gawande. It's a brilliant book. You can imbibe it in any function that you do. It's a very simple tool. It costs nothing, but having a checklist, if you want to learn about it, it's a very powerful tool. And that book is very well written.
I almost thought you were going to say Fountainhead by Ayn Rand. Almost thought. But I'm glad that you did raise that. But Nimesh, it's been a pleasure chatting with you. We've been at it for almost an hour. I didn't realize that we've gone the whole course. But I hope you enjoyed being on.
Oh, this was lovely. And I just don't want to say this for the heck of saying it. But this was a very different kind of conversation that I had. I had thoroughly enjoyed it. And I've been very candid also. So feel free to put a beep whenever you think I've said something which is wrong. I've been very open and candid, and I have not kept any particular guard on while conversing. This is what I generally feel. So this is what I've spoken.
Nothing controversial, nothing to beep. It's been a pleasure, Nimesh. Thank you so much. I've learned a lot myself, and I'm sure all the participants who logged in also have walked away a lot more knowledgeable hearing you and your style of investing and your outlook towards various aspects, not just investing, life in general. So stay safe. Hopefully I'll see you in person soon once all of this is behind us. And it's been an absolute pleasure. Thank you so much for taking time on this evening and doing this.
Thank you so much. Pleasure is all mine. And all the best, and stay safe, all of you.
You too. Thank you so much, Nimesh. Take care.